and why commercial lending is different than residential. Understanding underwriting, DSCR, NOI, and property income. And many borrowers assume commercial lending works just like getting a home mortgage. And in reality, commercial real estate financing follows an entirely different set of underwriting principles. So while residential lenders primarily evaluate the borrower, commercial lenders primarily evaluate the property and its ability to generate enough income to repay the loan. And understanding that simple difference can dramatically improve your chances of securing financing while helping you choose the right loan program from the beginning. Residential lending focuses on the borrower. So when purchasing a home, lenders primarily are going to evaluate the client's credit score and personal income and their debt to income ratio, or DTI, but also their employment histories and their asset and reserves and what their tax returns look like. And the home itself is simply the collateral. And the lender is betting that you will continue earning enough income to make the mortgage payment based off of the income you're currently making. And commercial lending will focus on the property. So commercial lenders really ask different sets of questions. So will this property generate enough cash flow to safely repay the loan is the key question. And instead of emphasizing your paycheck, lenders evaluate the property income and property expenses and the lease stability and the occupancy and the market conditions and property management and sponsor experience and cash reserves. So the stronger the property's financial performance is, the stronger the financing options will become. Net operating income, or NOI, it's the foundation of commercial lending. And one of the most important concepts in commercial lending is net operating income, or NOI. And NOI represents the property's annual income after normal operating expenses, but before their debt payments and depreciation and income tax effects. So the formula for that is pretty simple. It's NOI is your gross rental income minus your operating expenses and what's left over. And operating expenses typically include, say, property taxes or the insurance, maintenance of the property, property management, repairs, utilities, but only when the owner's paying them. Now, NOI does not include your mortgage payments, your depreciation, any capital improvements, any owner income taxes. NOI measures how much cash the property produces before debt service gets introduced. So, debt service and debt service coverage ratio in DSCR. And after calculating NOI, lenders determine whether the property can comfortably support the proposed loan payment. And that's where debt service coverage ratio, or DSCR, comes into play. And that formula is pretty simple as well. The DSCR is equal to the NOI, the income, divided by your annual debt service, whatever your payments are for the year. So say, for example, you have net operating income of $250,000 and your annual loan payments are $200,000. Your DSCR is 1.25. And that means that the property generates 25% more income than required to make its annual loan payments. And most commercial lenders will prefer a minimum of 1.2, but a lot of banks are about 1.35 or higher debt service coverage ratio for stronger leverage and better pricing. And higher DSCR generally leads to better interest rates and more loan proceeds and easier approvals and more lender competition for your deal. Why property income matters more than personal income. And residential lending is based largely on your ability to repay. And commercial lending is based largely on the property's ability to repay. So even borrowers with very high personal income may struggle to obtain financing if the property produces insufficient cash flow. Conversely, an income-producing property with strong NOI and a healthy debt service coverage ratio can often qualify for attractive financing even when the borrower's personal income is relatively modest. Commercial underwriting is more comprehensive, and commercial underwriting also considers factors such as the occupancy, and stable occupancy reduces lender risk. The lease terms, so long-term leases with financially strong tenants improve your overall loan quality. The property type, different lenders specialize in different deals. So from multifamily to retail to office to industrial to hospitality to self-storage to medical properties to mixed-use properties to senior housing or manufactured housing. The point is, choosing the right lender is often just as important as choosing the right property. And every lender has different credit guidelines and how they approach things. So unlike residential mortgages, commercial lending has tremendous flexibility. And different lenders may have unique preferences, say for loan size or property type or geography or experience requirements. Or some may just love construction and value add projects, but others specialize in bridge loans or SBA lending and permanent financing. And this is why experienced commercial mortgage advisors often secure financing for deals that individual banks can decline. So why working with a commercial mortgage advisor matters? Well, an experienced capital advisor understands which lenders specialize in your asset type and the current underwriting guidelines and loan structuring and DSCR optimization, but also SBA options, bridge financing, construction lending, and agency financing. So instead of forcing a square peg into a round hole or one deal into one bank's lending box, an advisor can shop your opportunity across hundreds of lenders to find the best fit for you. Final thoughts. Commercial lending is fundamentally different from residential lending because lenders are investing in the property's financial performance and not simply the borrower's paycheck. Understanding concepts like NOI and DSCR and underwriting standards and property cash flow allows investors and business owners to structure stronger deals and qualify for better financing and grow their portfolios with confidence. So whether you're acquiring your first commercial property or expanding a nationwide portfolio, working with an experienced commercial capital advisor can save time and improve loan terms and increase the probability of your closing. Are you ready to finance your next commercial property? Well, I'm your guy. My name's Bill Rapp. I'm with the CommLoan and Power program, and I help investors and business owners access financing through a nationwide network of more than 700 commercial lenders. So whether you're purchasing or refinancing a building or repositioning some commercial real estate, we can identify the lending solution that best fits your investment goals. And if you want to learn more, please visit billrapp.comloan.com and you can schedule a consultation so that way we can have a conversation. Thank you for watching. Have a good day.